So you've decided that enough is enough and you're finally going to put an end to procrastination and putting off investing in your own financial future rather than spending all your money on drinks at the bar and ultimately just a bunch of stuff that you don't need. But let me guess, you only have a finite amount of capital on hand in order to start your own dividend portfolio, and you probably have a million questions such as what's the best brokerage to use, what stock should I buy, funds, ETFs, just a bunch of different questions, right? Well, I'm here to tell you that it can seem relatively difficult to start your own dividend portfolio. However, you can create a pretty hands-off portfolio yourself with only a finite amount of cash, which is actually the topic that we're going to be speaking about in today's video. Hey, what's going on, everyone? I hope you're all having a fantastic day and that you're constantly learning new things in order to expand your knowledge. My name's Griffin, and in today's video, we're going to be looking at how you can go about creating your own properly diversified dividend portfolio with only a limited amount of capital on hand, such as, for example, $3,000 for the sake of today's video, which, by the way, is well enough to create a solid foundation for your portfolio moving forward. I've personally been in your own shoes, honestly not too long ago, wanting to create my own dividend portfolio, but not necessarily knowing which resources to utilize, where to look, which dividend stocks to purchase, etc., etc. And back then, I really wish that there was a video such as this one in order to help me out, but lucky for you, all my videos on my channel, as well as this one, are created to help investors of all spectrums refine your own portfolio and add some really solid stocks to your portfolio for future growth. So that's just it. In today's video, we're going to be going over a variety of different dividend stocks, as well as ETFs, REITs, and fixed income securities that you can add to your own portfolio in order to have a well-diversified asset mixture based on your investor profile and age, as well as a variety of other criteria. And just before we move further into the content of today's video, if you're interested in receiving your own copy of a stock market portfolio template that I created in Google Spreadsheets, which automatically updates with real-time market data, then make sure to check out the link down in the description for easy access to that template. I've divided the holdings by color-coded industries that you can update with your own securities in your own portfolio, and depending on your number of shares and market price, the spreadsheet will automatically give you your return per investment and for the overall portfolio. And finally, for the template, I've added a pie chart so that you can have a visual representation of how your holdings are distributed by industry or sector, and everything in this template is customizable to your own liking. So once again, this is a great starting point for your own portfolio. So if you want the link to that, check it out down below in the description. All right, so at this point, you've watched all of my videos where we go over individual stock picks, dividend stock picks, REIT picks, ETF picks, blah, blah, blah. It can be pretty confusing, right? But how do you go about absorbing this information and then reapplying it into your own situation to craft a portfolio that's well balanced and suits your needs as an investor, right? What type of capital should you be utilizing at the beginning in order to deploy it into different asset types in order to have a portfolio that has the correct amount of fixed income securities and equity securities, because ultimately this is going to have an impact on both the short-term and the long-term gains of your portfolio. So that's really what we're going to be diving into in today's video, looking at how, as a new investor with $3,000 to start with, you can create your own portfolio that has the proper mixture of both fixed income and equity securities. And then we're also going to be looking at some concrete examples of securities that we covered in previous videos that can be directly applied to this material in today's video. Now, doesn't that sound like a blast? I thought so. Straight off the bat here, let's take a second to go over expectations of returns and expectations of dividend income for a typical dividend investment portfolio, starting with $3,000, because it's important to know moving in here that with dividend value growth investing, you're not going to see a 50% return year over year of your investment. That's just really not all that realistic for a dividend growth portfolio, because we invest here in stocks that have a consistent track record of both growth, but then also dividend appreciation over time. And so for this reason, it's important to go over expectations, because you're not going to be looking here at dumping all your cash in a Tesla or a Shopify and getting like a 200% return on your first year. Obviously, it's pretty difficult, and some would say impossible even, to pinpoint exactly what type of returns you would receive with your portfolio, because every single portfolio is going to fluctuate differently throughout the year and receive different income. However, with this portfolio, we're looking here at investing in dividend stocks that were typically going to yield between a 2.5% to about 6% dividend yield on an annual basis, which is typical for a solid dividend stock. Doing some quick math here, on a $3,000 investment portfolio, these yields would give you between $70 and about $180 in dividend income on a yearly basis, which, if you're thinking to yourself that this isn't all that much money, well, you're right, it's honestly not all that much income. However, remember here that this is dividend income that you're generating for doing absolutely nothing, zero. While you're sleeping, you're generating dividend income, and if you reinvest this income back into your portfolio and buy more shares, well, in combination with sporadic contributions from your part, this is going to significantly compound over time and have a net positive impact on the growth of your portfolio. And let's not forget here, actual interest incurred on our securities, which typically with the investments that we're going to be looking at here, these dividend stocks, you can expect anywhere between about 4% to all the way up to about 10% on a yearly basis, especially with the all-time market highs as of right now. So all in all here, if you were to deploy this dividend income strategy into your own portfolio, you could expect, with dividend as well as interest incurred on your investments, anywhere between about 6% to all the way up to even 15% on an annual basis. But obviously, every single portfolio is going to have different results. All right, so with all of that out of the way, let's finally dive into the juicy part of the video, which is why you're here in the first place, and that is how to structure your portfolio. And this is going to take into consideration certain factors such as, one, your age, as well as your risk tolerance as an investor, and finally, your overall goals as an investor. Now, the way that you allocate your capital to different asset classes within your overall portfolio and the weight that you give each one is going to have a significant impact on the returns that you can expect with your portfolio. Now, as a rule of thumb, and obviously take this with a grain of salt and apply it to your own situation and your own profile as an investor, if you're, let's say, under about 30 years old, you're typically going to have a much longer time horizon in front of you, meaning the time that you have in the market to ride through both bull markets and bear markets potentially. Well, this is going to be typically much longer than someone who's in their 40s or 50s. So generally speaking here, you can typically have a much higher risk tolerance, and for this reason, you can allocate a lot more of your capital to equity positions such as individual stocks, as well as ETFs that hold individual stocks rather than fixed income, because you're going to have, once again, a longer time horizon in front of you, and typically holding a higher percentage of equity positions in your portfolio is going to reap higher rewards over the long term. Because I'm currently in my early 20s, I therefore have a higher risk tolerance, and that's just a personal choice, but for this reason, I currently structure my overall stock portfolio as 85% equities, so stocks, ETFs that hold stocks, and then also REITs, and then only about 15% is fixed income. And personally, I don't want to go about picking and choosing my own bonds, so for this reason, I just park that 15% of capital straight into an ETF that currently holds a bunch of bonds. I just park them there and forget about it. And by the way, we're going to be speaking about this ETF in detail in the coming minutes. If you're a bit older, however, you might want to structure your portfolio on a more conservative basis. So an allocation split such as, say, 60-40 or maybe even a 50-50 split of fixed income and then equities might be more suitable for your needs as an investor. So once again, absorb this information from your own perspective and then apply it into your own portfolio based on what's going to suit you best as an investor. And by the way, let me just put this out there. If you're watching this video and thinking like, I don't even know what a bond is or some of these other terms that we covered in the video, then don't worry, I've got you, because I made a full video, part 1 and 2, about stock market terminology for beginners beginners. So if that interests you, there's links down in the description to those videos so that you can get a foundation of the terms that are commonly used in stock market investing. So for this video, because the large majority of my viewers are in that under 30 bracket, we're going to be looking at a portfolio that is again 85% equities and then 15% fixed income, because the thing is, if you're in it for the long run, which you should be if you're a value dividend investor, well, even if there is somewhat of a market downturn or a correction, if you just hold on to these stocks, your equities, and just ride through the correction for the 1, 2, or 3 years that it takes to recover, and you don't sell, well, you're almost always going to come out advantageous or farther ahead than a portfolio that was, let's say, 60-40 of an asset split. Let's start off with that fixed income position first so that we can get that 15% out of the way, and in this particular case, that represents $430 of our initial $3,000 investment. If I were you, I would personally just put that 15% or $430 straight into a fixed income ETF, such as, for example, Vanguard's VAB ETF or BMO's Aggregate Bond Index ETF, which are both great funds that have low management fees and are going to expose you to a variety of different fixed income instruments such as short and long-term government bonds. And now for the equity positions with that 85% left over, which happens to be $2,570. What are some good dividend income assets, such as, for example, ETFs or dividend stocks that you can add to your portfolio for both long-term appreciation of share value as well as some juicy dividend income while we're at it? Well, there's really two typical courses of action that you can decide to undertake here. The first one being a lot more hands-off and passive as an investment by investing exclusively in ETFs. And then the second one is going to be a lot more hands-on by picking and choosing your own dividend securities, or just any securities for that matter. And this is going to be a much more active and hands-on approach to your investing. Let's start off with that first option of investing your 85% of funds here into broad market dividend specific exchange traded funds, which is going to provide your portfolio with diversification as well as consistent and steady dividend income, which is going to be all on a quite passive basis because your investment in ETFs is going to expose you to a variety of different assets within one single holding. And what I just said there kind of sounds pretty golden. So yeah, ETFs might be the right option for you if you're looking for a more passive and hands-off approach here. It kind of goes without saying here that obviously there's going to be a handful of really good dividend specific ETFs that you can choose from as an investor, but two really good options here to narrow down would be number one, the Vanguard FTSE Canadian High Dividend Yield Index ETF, ticker symbol VDY, which currently trades in and around $35 with a management fee of only 0.2% and a 12-month trailing yield of right around 4.3%, which is quite high, especially for an ETF that has such a low management fee. VDY currently has 54 holdings, most heavily weighted in both the financials as well as the energy sector, which if you've watched any of my previous videos, you would know that this is quite typical because these sectors in Canada specifically tend to pay out quite high dividend distributions. Another great option for a Canadian high dividend yielding specific ETF would be the iShares Composite High Dividend Yield ETF, also known under the ticker symbol XEI. You can currently pick up shares of XEI for right around $23 with a management fee of only 0.2% and a 12-month trailing yield of right around 4.7%, so quite high once again here. And this fund actually has 77 holdings, so a bit more than the last one we just looked at, with once again the most heavily weighted sectors being the financial and energy sectors. All right, so now that we know that ETFs can really be a great option for overall diversification of your holdings within your portfolio, and ETFs can also provide dividend income, well, what if you're thinking right now, I kind of want to just take a crack at picking and choosing my own specific dividend stocks instead of just going and putting my funds into an ETF. I kind of want to have a more hands-on approach with my investments. Well, cool. I honestly like to hold a variety of ETFs as well as individual dividend stocks myself in my own portfolio. So with $2,570 left over of our initial $3,000 here, this is well enough to go about picking and choosing your own stocks. So let's get right into it. If you want to take the approach of picking and choosing your own dividend stocks here, well, it's still really important that you understand the value of diversifying your holdings because you don't want to put all your eggs in one basket. This this is going to overexpose you to one single asset, and your fluctuations in market value can really have a significant impact on your portfolio. So with about $2,500 here, you're gonna wanna go and choose about 5 to 6 different stocks at a minimum. About 5 to 6 is actually pretty ideal with $2,500. So this is gonna be a really good starting point with that initial capital. As an investor looking for both share appreciation over the long term as well as increased dividend distributions over time, I would personally recommend that you go about investing in Canadian dividend aristocrats, such as, for example, with large banks such as TD, RBC, Scotiabank, or CIBC. Or you could also go about investing in high dividend paying aristocrats in the energy sector, such as, for example, TC Pipeline, Fortis, and Canada Utilities. Some other great options of high dividend distributing Canadian aristocrats would be in the real estate investment trust sector, so REIT for short here, such as, for example, CT.UN, CAR.UN, or GRT.UN, which are some of my favorite REITs that we've covered in previous videos. And if you're wondering what a dividend aristocrat is, then make sure to check out the video that's overlaying right now, because this is going to provide you with all the necessary information with understanding how a dividend aristocrat works in Canada and what it does and how it can work to your advantage in your portfolio. I would personally split that 85% relatively equally between, once again, about 5 to 6 of the securities that we just spoke about, or any of the securities that we've covered in previous videos. But remember here that diversification is key. You don't want to put all your eggs in one single basket. So bottom line, if you're a new investor who wants to get into the market but you have a limited capital on hand, it might be $3,000, $2,000, or even $1,000. Well, this is still well enough to just get your feet wet and start investing and building your own dividend portfolio. But just remember that it's really important to properly assess your own profile as an investor and take into consideration your age with your investment horizon or your risk profile as an investor, and then properly allocate your capital to a healthy mixture of both fixed income and equities. And with recurring contributions for your part, you're going to be on the right path for success with your portfolio. I really hope you enjoyed this video and it gave you some further insight as to how you can craft your own portfolio if you only have limited capital on hand. And if you want to learn more about dividend aristocrats, then make sure to check out the video right here. You're going to learn all about it, what it is, and how you can utilize them. And on that note, thanks a lot for watching, and I'll see you in the next video.